The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Plan Design Features to Consider for 2023 with Jason Worms and Carrie Teague. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Jason and Carrie. A reminder that the Q&A portion will be held at the end of the session, and they will answer as many questions as time permits. Please be sure to make your questions as descriptive and, if possible, include the slide number. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credit, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce Nova's very own Jason Worms, team leader for the Defined Contribution Administration team, and Carrie Teagues, senior account manager for the Defined Contribution Administration team.
Thank you, Yvette. This is Carrie. I'm gonna lead off and just from a technical standpoint, Jason is advancing the slides for me. So can we go to the first slide? Just a little bit of housekeeping information to get this out of the way. Keep in mind that this is an informational presentation. It's general. It's not intended to be a substitute for legal or tax advice. And if you do need that type of advice, you should seek out a qualified professional such as an ERISA attorney or an accountant if you do need that type of advice. Okay, next slide. Little more housekeeping. Yvette mentioned if you need continuing education credit, if you need CPA credit, this is the specifics, Nova's provider number. You have to be registered individually. With all CE credit, you have to be present for the entire webinar and return the evaluation form that will be sent out within a week or so of this presentation. Okay, let's look at what we're in store for today. The agenda is, why would you consider making changes to your plan? That's the first thing we're going to take a look at. Kind of the landscape, the current contribution limits and other plan limits that are applicable to qualified plans. And then we're going to, both myself and Jason, look at some specific plan design features to consider. And then finally, if those plan design features are something that you want to move forward with, what the requirements are in terms of amending your current plan document. And then, as Yvette said, we'll answer any questions or as many questions as possible that you all have at the end of the presentation. Okay, with any good webinar, we have objectives in mind. What do we want you to be able to do at the end of this webinar? Ideally, we want you to be able to discuss, maybe internally or, with others in your firm, the reasons that you might want to make a change to your plan, why you should even consider making changes. And then specifically, identify within your own plan specific design features that you might want to change to, things that you might want to add or tweak within your own plan design. And then lastly, if you do decide to make changes, what the requirements are in terms of timing of affecting those changes and plan amendments that are required to make that happen. Okay, so first off, why would you consider making any changes? A lot of 401k plans have been around for quite some time. A lot of employers, most employers actually have a 401k plan, and it may have been put in place and designed the way that it was for your demographics, your objectives at that time. Things could have changed, your demographics could have changed, your participation has fallen off, etc. So the, that's kind of one of the primary reasons to think about making changes to your plan and evaluate whether it meets your current needs. Also the current state of the economy, which everybody is affected by. Some plan sponsors within the past couple of years may have reduced benefits and are now looking at reinstating them. Regulations have changed, so there are features that are now possible to be added to plans that were created by various regulations. Your record keeper vendors, most vendors are sort of in a mode of continuous improvement. They've made system improvements. A lot of activities are automated, so there, it may be possible to add a feature that was very manual in the past, but now your record keeper is able to automate it. If you're like the rest of the world, recruiting and retaining top talent has become a huge challenge. So if you have, for example, a hire that's weighing joining your firm versus another firm and the other firm's 401k plan is better, you don't want to be in a position to lose that key hire because of your 401k plan. And then lastly, we don't necessarily like plan sponsors or think it's a good idea for plan sponsors to make changes to their plan design based on a single employee's request. That's not what we're suggesting here. But you may be getting questions from employees who have seen things in the news or read about things or talked to other people and come to you saying, hey, do we have this in our plan? If we don't, why not? So things along those lines, if you're getting questions from employees that might cause you to think, why don't we have this? Let's think about it. Next slide, please. Okay, so the current limits, and these are indexed every year and released by the IRS. For 2022, the 401k deferral limit, so the employee contribution limit for someone who is under age 50 is $20,500. If that person is at least age 50 or will be age 50 within 2022, then he or she can defer up to an additional $6,500, making their deferral limit for 2022 $27,000. The IRS also limits compensation that can be considered for qualified plan purposes. That limit for 2022 is $305,000. So where that comes into play is if you have an individual whose compensation is more than that, and you're calculating an employer contribution or employer match. If, for example, the match is 100% of the first 4% deferred, then that 4% of compensation is capped at $305,000, and that then limits the match. The 415 annual additions limit speaks to the limit on all contributions to an employee's account, inclusive of his or her own contributions and all types of employer contributions. So that would take into consideration match, profit sharing, non-elective contributions, etc. That limit for someone who is under age 50 for 2022 is $61,000. And again, as we said above, if someone is age 50 or more, then an additional $6,500 gets added to that number for the total limit. These numbers are released typically in the fall, in the October-November timeframe. So for 2023, we will be looking out for the new numbers, what they're indexed to, if they are. We don't know. We don't have a crystal ball, but as soon as they are released, we will, of course, inform all of our clients. Okay, now let's kind of dig into the meat of things that you might want to look at changing. Eligibility in your plan is unique to your plan. It's defined in your plan document, and it's what the requirements are for someone to be able to contribute to your plan. The range is from immediate, as in the date that someone is hired, to the most stringent eligibility that you can require someone to satisfy before contributing is to be age 21 and to have completed a year of service, and then further only offer 2 entry dates, so semi-annual entry dates. The benefits of changing eligibility is, if you're reducing it, if you have more stringent eligibility and you want to make it more beneficial, kind of pull the service requirement back, is that you get people into the plan earlier. You're allowing more people to save for retirement. And if you have the type of plan that is subject to non-discrimination testing, we'll deal with that later, more specifically, it could help in terms of improving your non-discrimination testing results. And then, we're always kind of keeping an eye on making your plan more attractive in this hiring environment, in this labor market, getting people into the plan earlier when you're trying to attract a mid-career hire, and having that person be able to get into the plan earlier as opposed to waiting. If someone's been in a 401k plan their entire career, they don't want to take a year out from contributing. That can be more beneficial as well. And every one of these features will kind of, weigh the benefits with not necessarily the cost, but things to be mindful of. So we caution you that, it stands to reason that if you get more people into the plan and you have an employer match or an employer profit sharing contribution, then that contribution cost is going to increase just by virtue of having a larger population who receives that contribution. So in this case, you just sort of have to, weigh the overall benefits against the overall cost, literally the dollar cost. Next slide. Okay, so there is sort of a workaround. It is possible to have dual eligibility, which means that there's one eligibility criteria that applies to employees being able to contribute to the plan, their 401k deferrals, and then a second second set of eligibility requirements that apply to employer contributions. So it is possible to make 401k deferral eligibility less stringent, so require less time, and then keep the maximum eligibility on employer contributions. So you can have, for example, a 90-day requirement on 401k deferrals and the whole 1 year and 21 required for employer contributions. One thing to caution, again, is that if you have, and this is fairly specific, if you have a safe harbor plan, and safe harbor plans, when the only contribution that's made is the safe harbor contribution, if that plan is top heavy, then it's deemed to satisfy the top heavy minimum requirements. If a safe harbor plan has dual eligibility, that wonderful aspect of safe harbor contributions deeming to satisfy the top heavy minimum is invalidated. So that is one drawback. Next slide, please. Okay, so I mentioned non-discrimination testing earlier. This is where we dive into it a little bit deeper. And for those of you who have safe harbor plans, you can multitask at this point in time. Non-safe harbor plans are subject to what is referred to as ADP testing, and that stands for average deferral percentage testing. That test compares the rate of deferrals, and that deferral percentage for each individual is literally his or her contributions divided by his or her gross compensation for the year. So it compares the rate of deferrals that the highly compensated employee group makes on average to the rate of deferrals made by the non-highly compensated employee group on average. If that test is failed, typically the way that it's corrected is that excess contributions are refunded to highly compensated employees. So the point of this slide is that there are two options with respect to the mechanics of how you perform that testing. And those mechanics, the testing methodology that your plan is required to use is stated in your plan document. So there are two different types. This is out of order, but current year testing is kind of the most straightforward to explain. I explained the test mechanics. It's the highly compensated employee average compared to the non-highly compensated employee average. That average for non-highly compensated employees in current year testing is for the current year. So, for example, if we're doing testing for 2022 and we're trying to determine the maximum average for highly compensated employees, we look at the average for non-highly compensated employees for 2022. If, on the other hand, the plan provides for the prior year testing method, the average for non-highly compensated employees for 2021 would be used to determine the maximum for highly compensated employees for 2022. As an aside, the mechanics are the same if you have a match in the plan as well or after-tax contributions for the ADP test and the ACP test. The mechanics are the same. So one of the benefits, I guess, of prior year testing is that it's kind of a good planning tool. So if it's attractive to you if you have a plan that's ADP tested, and you're tired of waiting until after the end of the plan year and having sort of a surprise in terms of what the results are going to look like and then any corrective actions that need to be made, a prior year tested plan, going into the next plan year. So for example, I keep using 22 testing as an example. By the time we've done 21 testing, you'll know what the maximum average is for highly compensated employees for 2022. So that's one possible attractive feature. There is one drawback, however, with prior year testing as compared to current year testing. If the test is failed, when you're a current year tested plan, you have two possibilities to correct that test failure. You can either make refunds to highly compensated employees of the excess, or you have the ability to make a non-qualified contribution, an additional contribution to non-highly compensated employees to boost their average. If the plan is prior year tested, that qualified non-elective contribution corrective route is not possible. Prior year tested plans can only be corrected by making refunds to highly compensated employees. Next slide, please. Okay, in contrast to plans that are subject to ADP and ACP non-discrimination testing are safe harbor plans. There were first, this possibility, this type of design was first introduced in 1999. Sponsors that have traditionally, some plans are safe harbor right out of the gate, and some plans, once this became possible and then years later, decided to convert to safe harbor because they've had chronic issues passing non-discrimination testing. If they have low participation among the non-highly compensated employee group, and you've got frustrated highly compensated employees who are tired of getting refunds every year and are very vocal about it, having a safe harbor results in your highly compensated employees only being limited by the IRS maximums. So they can contribute up to those maximums and there are no refunds associated with testing. Next slide. So this is a design choice, and as a result, there are some requirements. First of which, and the primary requirement, is that there is a required employer contribution. There are two different options in terms of how you structure that employer safe harbor contribution. One is a non-elective contribution. What that means is it is allocated to all eligible participants. Doesn't matter whether someone contributes or not, and the minimum required non-elective safe harbor contribution is 3% of compensation to all eligible employees for the year. In contrast, if you'd rather benefit people who are taking advantage of the plan themselves and contributing themselves, then the safe harbor contribution can be structured as a match. So it would only go to people who are contributing on their own. There's a minimum requirement, what's often referred to as a safe harbor basic match. This is the absolute minimum structure for a safe harbor match. Slightly complicated in terms of how to communicate it, but the formula is 100% of the employee's deferrals, the first 3% of their deferrals, plus 50% of the next 2% of their deferrals. So that's the basic. If you want to be a safe harbor and you want to structure the employer contribution as a match, and you'd rather do something more straightforward, as long as it's at least at the level of the basic match, then you're fine. So some plan sponsors just skip the whole tiered approach and go to a straight enhanced match. One common example is 100% of deferrals up to the first 4% of compensation, but it could be 100% on the first 6%, et cetera. So that's really the primary requirement of safe harbor plans. Next. The benefits of a safe harbor plan, what I mentioned on the earlier slide, your highly compensated employees, in contrast, in a plan that's subject to ADP testing and has failed and they've experienced refunds, that's gone. You're exempt from that testing. So the only limit for highly compensated employees is the IRS maximum. If your plan is top heavy and the safe harbor contribution is the only employer contribution that's made, then the plan is deemed to satisfy the top heavy minimum contribution requirement. So no additional requirements, no additional contributions. And then if your plan is one where you choose to allocate what's referred to as a new comparability profit sharing contribution, which is very, very succinctly one in which it's inherently discriminatory, because what you're intending to skew more of the profit sharing dollars to a certain group of people, then the safe harbor contribution can help in terms of providing the minimum gateway contribution for the non-discrimination testing that is unique to that type of contribution allocation. Next slide, please. Okay, so like I said, in every one of these features, we're explaining it, talking about the benefits, but then from a realistic standpoint, these are things that you need to keep in mind. Already said, there is a required employer contribution. You cannot be a safe harbor without having an employer contribution, and the required modifier needs to be underlined because it is something that you can't dip in and out of, so to speak, from year to year unless you amend your plan. If you are a safe harbor, you are required to make that safe harbor contribution as provided in your plan. In addition, we see with discretionary contributions in some plan designs, you can add additional requirements. Someone meets the eligibility, but then some plan sponsors have, oh, well, we don't want to give this match to anyone who worked, for example, less than 1,000 hours or who wasn't employed on the last day of the plan year. That can apply in the case of safe harbor employer contributions. If someone's eligible, they get the contribution. No other constraints. Other than one very specific type of an auto-enroll safe harbor, which Jason will talk about later in the presentation, all other safe harbor designs, the employer contribution must be fully vested. There is no vesting schedule that is permitted on an employer safe harbor contribution. It is possible to elect to change your plan to a safe harbor later in the year. So, we're sitting here more than halfway through the 2022 plan year. And let's say Nova does a mid-year non-discrimination test for you, and it looks like you're going to fail at year end, and you're tired of failing, your HCs are tired of refunds. It is possible to amend your plan within 2022 to become a safe harbor for 2022. Gets rid of non-discrimination testing for that year, but the constraint is if you amend the plan within the year, then the options in terms of types of employer safe harbor contributions are non-existent. You can only do that by having a non-elective contribution. It's possible to then amend it prospectively for a future plan year. Can you go back to the last slide? Yeah. it's possible to amend that for a future plan year to switch to a safe harbor match if that's what you prefer. But amending a plan to be a safe harbor with the employer contribution as a match is a prospective change. So it can only be done for a future plan year. There is one other sort of unique type of safe harbor design. You can have your plan designated as a safe harbor maybe. Have a few of those plans, and the way those work is that they do decide from year to year whether they want to be a safe harbor, but that's noted in the plan. It is noted as a safe harbor maybe. Those participants are provided with a notice in advance of the plan year saying, hey, our plan might be a safe harbor. We'll let you know later. If the plan sponsor then decides to elect the safe harbor for that year, then a subsequent notice is sent out. And then one last thing to keep in mind with respect to safe harbor plans, the ability to amend the plan mid-year. So for an amendment or a change to be effective in the middle of a plan year is restricted. There are only certain reasons or certain features that can be amended in a safe harbor plan other than prospectively for the upcoming plan year. Okay, next slide. Okay, there are a few changes that were included in the Secure Act that apply specifically to safe harbor plans. Those of you who have had safe harbor plans for a while are accustomed to distributing the required notice before the upcoming plan year. Essentially, it's required language that tells participants, hey, we have a plan, it's safe harbor, here's how it works, here are the appropriate features. That annual notice requirement, if your plan is a safe harbor with the employer contribution as a non-elective contribution, that annual notice requirement is gone. It's still required, however, if your plan is a safe harbor and your employer contribution is structured as a match, or as I was mentioning on the earlier slide, if you have a safe harbor maybe plan. So those two types of plans are still required to do an annual notice. The safe harbor non-elective plan is not. I already mentioned that it is possible to amend within the plan year to be a safe harbor for that plan year. If you do that, as I said earlier, the employer contribution has to be structured as a non-elective. And even if you make the change as late as December 1st of the year, that 3% non-elective contribution has to be allocated for the year on all eligible compensation for the entire year. One of the other very helpful things that was included in the Secure Act is the ability to amend the plan retroactively as a safe harbor. So, for example, we are, fast forward and we're in the first quarter of 2023 and we're doing non-discrimination testing for your plan and you're failing and there are significant refunds and you just are frustrated and don't want to do it. It is possible to retroactively amend your plan to be a safe harbor for the 2022 plan year, but that 3% non-elective contribution in a retroactive amendment then gets increased to 4%. And it would similarly have to be allocated on all compensation for the plan year. But then you are eliminating the, as I described in the example, highly compensated employee refunds because you are, by virtue of that retroactive amendment, exempting your plan from ADP testing for the year. Next slide. Okay, Roth 401k contributions. What's a Roth? Most plans that we administer do offer Roth deferrals, but it is a feature that's kind of been around for a while. It was first introduced as a possibility as a deferral type in 2006. It is a 401k deferral, so an employee deferral that's withheld from his or her pay on a post-tax basis as compared to traditional 401k deferrals, which are withheld from pay on a pre-tax basis. So the benefits of Roth 401k deferrals are essentially tax-free growth. So any earnings on those Roth 401k deferrals grow tax-free. Adding Roth or having Roth in a plan in a lot of cases benefits those employees who sort of feel, I won't say they have a crystal ball, but they're in a lower tax bracket now and they anticipate that they're going to be in a higher tax bracket in retirement. So the ability to diversify from a tax standpoint is attractive and kind of offers, a different level of diversity in your plan over and above your investment diversity. So you're offering not only different ways for employees to invest, but different tax treatments of their contributions that are going into the plan. Next slide. So one other difference beyond what I just described on the last slide, there are comparing Roth 401k deferrals in a qualified plan to Roth IRAs. For Roth IRAs, some people are shut out based on their compensation. With Roth 401k deferrals, there are no income limits. If you're eligible for the plan and the plan has a Roth feature, then you can contribute. The contribution levels, comparing a Roth IRA to a Roth 401k plan, in a Roth 401k plan, the amount that can be contributed on a Roth basis is higher than for a Roth IRA. Okay, very, very, very brief side by side. There's a lot on this slide, but there's really not a lot that's different comparing the two. Most of this I've already mentioned. Roth 401k deferrals are withheld on an after-tax basis at the payroll level. Traditional 401k deferrals are withheld on a pre-tax basis. In both cases, there's no income limitation, as I said before. In both cases, the IRS limit on those deferrals is $20,500, specifically, as I said, for someone who's under age 50. That limit applies individually as well as collectively. So if someone, for example, elected to contribute 6% on a traditional 401k basis and 10% on a Roth 401k basis, that deferral amount in total, both types, is limited to $20,500. It's not an individual limit applied by deferral type. The other big difference is that if someone withdraws money from a Roth account, it is completely tax-free as long as it's what's considered a qualified withdrawal. And in order to be qualified, there are two constraints. If the participant is at least age 59 and a half, and the account in the plan, the Roth account in the plan, has been held for at least 5 years, then what they withdraw from that is not subject to taxes. In contrast, any pre-tax monies withdrawn from the 401k plan are taxed. There are no exemptions whatsoever. And then the last point is with respect to required minimum distributions at either age 70 and a half or age 72, there's no difference in that requirement as it applies to a participant's balance, whether they contributed on a Roth basis or a traditional 401k basis. Next slide. Okay, so if it is something that you don't have in the plan and it is something that you would like to add, these are, for the most part, the things that you need to keep in mind. It is an additional money source for payroll purposes. It has to be set up as a separate deduction, separate from, if someone wants to do pre-tax 401k, the Roth 401k deduction has to be separate and distinct. And then on the sort of receiving end at your record keeper, the money source, the Roth money source, has to be set up as a separate bucket, if you will, to accept those contributions. They have to be record kept separately because of the different tax treatment. And then, as I said, with respect to withdrawals, you have to be able to separately track Roth contributions to ensure that when someone comes back and says, hey, I want to take this money out, you have to be able to point to that Roth money and know how long it's been in the plan. I mentioned on the prior slide that you can elect, a participant can elect separate percentages for 401k and Roth. They could go all one, all the other, or part one and part the other. If you have a plan that is not a safe harbor, subject to ADP testing requirements, Roth deferrals are combined with pre-tax deferrals for ADP testing. So they are treated as a deferral, period. There's no distinction because of the tax differences. A deferral is a deferral is a deferral when it comes to ADP testing. If your plan has a match as well, again, a deferral is a deferral is a deferral. The match applies to all deferrals, whether made on a pre-tax basis, on a Roth basis, or both. And then Roth conversions or in-plan Roth rollovers, I'm going to talk about on the next few slides. That's a feature that kind of goes hand in hand with Roth contributions, doesn't have to, but that's a feature that's unique to plans with Roth deferrals that came into play a few years after the Roth deferrals themselves. So we'll talk about that in just a second. But if you have Roth deferrals in the plan or when you add them, education is particularly important so that employees are mindful of and fully understand the basis that they're contributing on. You don't want someone, electing a Roth deferral if they didn't understand that it was going to be withheld from their pay on an after-tax basis. Next. Okay, so Roth 401k conversions, or they're sometimes referred to as Roth 401k in-plan rollovers or in-plan transfers. In order to add this particular feature to your plan, you have to also offer Roth 401k deferrals. They don't have to already be a feature. So for example, you could amend your plan to include both at once. Or if your plan already offers and has offered the ability to defer on a Roth basis for quite some time, but you didn't have, back to the last slide, you didn't have the ability to add in-plan Roth conversions. Can you go back to the last slide, please? Okay. You can add the in-plan Roth conversion either way, either coincident with having Roth deferrals or as an add-on after you've had Roth deferrals. They are kind of a unique animal. They essentially operate as someone decides that they want to take the tax hit on pre-tax money now. So someone takes their pre-tax balances, and all of this is defined in terms of, which balances, which money types, et cetera, are subject to this possibility. Those pre-tax balances are converted to a Roth balance. And at that time, at the time of the conversion, the participant has a tax burden. That is, it occurs and it's taxed in that year that they make the conversion. That does not mean that the plan is required from an administrative perspective to do the tax withholding, to handle it. It just means that the event causes a taxable event in and of itself. It is something, along with everything else that we've discussed, that has to be amended and provided for in your plan. So, we're sitting here in August of 22. If you decide that you want to add a Roth conversion feature, you just have to amend the plan by the last day of 2022 in order to make that effective. Next slide, please. Okay, and Jason is taking over from here.
All right. Thank you, Carrie. Appreciate all that info. So what I'm picking up with, folks, is talking about automatic enrollment. And what automatic enrollment is it's designed to be a way to increase participation in the plan, whether you do that kind of altruistically, like all of my participants need to put money away towards their own retirement, or you do it somewhat selfishly if you're an owner of a company. Like, the more people I can get to contribute to the plan, the more likely I am to pass my ADP test and I can contribute more myself. So either way, it's still the same rule. And what it does is it says that an employee is automatically enrolled in the plan to make deferrals unless they affirmatively tell you not to. So traditionally, plans have said you have to opt into the plan. What automatic enrollment does is flip that on its head and say, no, you have to tell us that you do not want to be part of the plan. And what that does is statistics have shown it increases the participation rate by the employees in the plan significantly. It also increases the chances of a plan passing an ADP and or ACP test that Carrie talked about earlier. Policymakers, so Congress, the Department of Labor, the IRS, they're making a push to include automatic enrollment for plans. Like they're trying to make it easier. They're trying to provide tax incentives for people that adopt this. And there's even talk of trying to make it a mandatory provision in retirement plans and various pieces of legislation that are moving through. So to give you kind of an idea of how automatic enrollment works, there are 3 types of automatic enrollment that are out there in the world. First one is just a regular old automatic contribution arrangement. And you can have this set up to apply to all of your employees. You can have it set up to apply to just new hires. There's a lot of flexibility in this. You can set the automatic enrollment rate at whatever you like. You can set it at 10%, you can set it at 1%, you can set it at 50%, but you're probably going to get a lot of people to opt out if you set it that high. But the automatic contribution arrangement is like how this whole thing started, just a very simple, basic way to force people to tell you that they don't want to be part of the plan. The second one, and the kind of the next tier up in how this works, is called an eligible automatic contribution arrangement. This one has to be put in effect at the beginning of your plan year. You can't adopt this thing mid-year, but what it does is it gives you a trade-off. It says you can set this up, and if you apply this eligible automatic contribution arrangement, then you have 6 months to refund any ADP, ACP failures instead of the 2.5 months that applies for the rest of the plans. So that is a benefit if your plan fails all the time. But the trade-off is that your eligible automatic contribution arrangement has to apply to everybody. It can't apply only to new hires, for example. So that's one of your options out there for an automatic enrollment. The third option, and the one with the kind of most restrictions on it, is a qualified automatic contribution arrangement. This one is essentially a safe harbor allocation. So like Carrie talked about earlier, if you have a safe harbor plan, an employer contribution is required. So you can make a safe harbor non-elective contribution where it goes to all of your employees who are eligible to contribute, or you can set it up as a match. And I think I go into more detail on this on the next slide. The special thing about this safe harbor contribution, though, is that it qualifies for a vesting schedule, which means that it doesn't have to be 100% vested to the employees the moment that it's made to the plan. You can require folks to work for you for up to 2 years before they're eligible to keep that safe harbor contribution if they terminate employment with you. The other thing about a qualified automatic contribution arrangement is that it requires that the deferral rate for folks be escalated up to a specific number. So if you have a starting deferral rate using this qualified automatic contribution arrangement that is under 6%, you have to increase the deferral rate for all of your folks that were automatically enrolled by 1 percentage point each year until they get up to at least 6%. Okay, so that auto escalation is a feature of this and does take a decent amount of administrative capacity to be able to stay on top of that like you're supposed to. Automatic enrollment, we get a lot of participation, right? A lot of, like the typical plan without automatic enrollment has a participation rate somewhere between 40 and 60%. If you get a plan that has automatic enrollment that applies to all employees, your participation rate jumps above 90%. Okay, so it's has a big time impact on the participation for your plan. If you do this, you got to be aware that there's trade-offs, right? If you have a plan that does an employer match contribution, all of a sudden, if you go from 60% of your employees contributing to 90, that's a big time increase in your match contribution, right? The total outlay that you make for that contribution is not going to be insignificant. The other thing is automatic enrollment requires additional administrative capacity. Again, going from 60% of your employees participating to 90 is a whole bunch of additional notices, a lot of additional forms, those types of things that your HR staff is going to be responsible for keeping on top of. So you want to make sure that you have the capacity within your team that is administering your plan to make this work if this is a path you want to go down. I mentioned this on the qualified automatic contribution arrangement, but it applies really to all of those options. Automatic escalation is an option that you can do to increase your employee deferral rates. Again, trying to use inertia that that employees have to help them contribute more towards their retirement. So the most common feature is that you take that automatic escalation and you increase the participant's deferral rate by 1 percentage point every year. The most common way of doing that is at the beginning of the plan year. Everybody who was automatically enrolled gets their deferral rate increased by 1 percentage point. This is, like I said, it's allowable in all 3 of the automatic contribution arrangements that I talked about on the previous slide. So whether it's just an automatic contribution arrangement, an eligible automatic contribution arrangement, or a qualified automatic contribution arrangement, you can do automatic escalation in all 3 of them. If you're doing the qualified automatic contribution arrangement, the safe harbor version, there is a cap on how much you can escalate a person's deferral rate to. And that cap was recently changed from 10% to 15%. So you can increase folks' deferral rate up to 15% of compensation using the qualified automatic contribution arrangement. As I mentioned on the previous slide, the minimum that you have to escalate to is 6%. So somewhere between 6 and 15% is where you set your cap for how high you escalate those folks' contribution rates. Okay, moving on. And we are talking about loans and hardship distributions. There's always a lot of chatter around these 2 types of withdrawals from the qualified plan. So we're going to take a minute, talk about them, and some considerations for these things. A participant loan is where a participant can take money out of the plan based on their vested account balance. The trick is it's a loan, so they have to repay it, and they repay it to their own account balance. Okay. The IRS says that in order for a loan to work in a qualified plan, it has to bear a reasonable interest rate. That reasonable interest rate, from NOVA's perspective, is the prime interest rate plus 2 percentage points. That we feel is a rate that is comparable to what a participant might get if they were going to a bank to get a loan, for example. The NOVA requires that participant loans be repaid by payroll deductions. So if you allow loans, you have to have a mechanism to set up those loan repayments in your payroll system so that you can transmit those loan repayments to the record keeper with your payroll contributions. We do that because if you force or allow participants to pay with personal checks, then the timing of those payments gets skewed very quickly. You end up having to follow up with participants for payments that were missed, and it just becomes an administrative hassle. So the payroll deduction is definitely the easiest way to do it. Plan sponsors can restrict the money source types that are allowable for participant loans. So for example, a plan can allow a participant to take a loan out of just the money that they put into the plan, the employee deferrals or the Roth deferrals. They don't have to allow them to take the money out of, say, an employer match source or a safe harbor money type. Like, it is entirely up to the plan sponsor to set those restrictions. You can also restrict what the reasons are for a participant to take a loan. Many plan sponsors that offer loans don't have a restriction on what the reason is, but some of them say you have to take a participant loan only for certain reasons. Like, for example, a loan has to be taken for something that qualifies as a financial hardship, which I'm going to get into in just a second. Those types of restrictions are allowed as long as they are not discriminatory against the non-highly compensated employees. Okay. The second option that we were talking about is a hardship withdrawal. A hardship withdrawal is different from a participant loan in that it does not have to be repaid to the plan. So the money comes out of the participant's account, and that money is just out of the plan permanently. It is a taxable withdrawal. So if a participant is underneath the age of 59 and a half, then it is taxable to them. They will get a Form 1099-R in January of the following year that indicates that the amount of the distribution is taxable income for their tax purposes. Hardship withdrawals are limited in the amount that can be taken to only cover the amount of an immediate and heavy financial need. So if you've got an eviction notice that says you need to pay me $6,000 or I'm going to evict you from your apartment, you can't take a hardship withdrawal out for $10,000. Okay, only the $6,000 would be available. Similar to the participant loans, plan sponsors can restrict the money type that is available for a hardship withdrawal. Most often, those restrictions, if they exist, are you can only take it out of the money that you put into the plan, right, out of your deferral source or the Roth source. But restrictions, you can set those restrictions any way that you like as a plan sponsor. So for a hardship withdrawal, there are only specific ways that you can take funds out of the plan. And so this slide lists them. Medical expenses is a big one. And the trick with medical expenses is they have to be unreimbursed medical expenses. So if you have a medical bill for $10,000, but that medical bill says $8,000 is going to be paid by your insurance, then the maximum of that bill that you can have with a hardship withdrawal is going to be $2,000. The second reason is to purchase a primary residence. So again, this is a primary residence. So this is the residence that you're going to be living in more than half of the year. So vacation homes, that type of stuff does not count for this purpose. And it has to be the purchase of that residence. It can't be for mortgage payments. Okay. Tuition and related educational fees is another big one. So if you're paying tuition expenses, then you can take a hardship withdrawal to cover that cost. Educational fees, books, those types of things are allowable for hardship withdrawals. If you've received notice that you are going to be evicted from or foreclosed on in your principal residence, you can take a hardship withdrawal to cover that cost as well. But again, it has to be an eviction or a foreclosure. It can't be a letter saying that you're just behind on your rent, et cetera, et cetera. It has to be the eviction or the foreclosure process. A hardship withdrawal can be taken for payment of funeral expenses for an immediate family member. So that's another thing that can be used. And then the newest one is this number 6, payment of expenses related to the repair of damage on a principal residence. So if you are in a place that has a federally declared disaster area, then you can qualify to repair your house and have a hardship withdrawal cover it. Again, you have to present a bill or an invoice for that service to back up the charges. But if you're in a federally declared disaster area, that would be a permissible hardship withdrawal. All right, loans and hardship withdrawals, if you allow them in the plan, they do come with a cost. So the record keeper and or NOVA will have fees that apply to participants who apply for these items. Those fees are typically paid by the participant. It is additional administrative work on the plan sponsor's part, especially for the hardship withdrawals, because the plan sponsor is going to be asked to make sure that those participants have that documentation that is needed. It's also going to be an additional employee request. So is your HR staff able to take the additional burden of having employees come and asking if they're eligible for a hardship, or does this bill count, or what kind of a loan can I get? What would my payment be every other week with my paycheck if I took a participant loan of $10,000? What if I took it for 15? What if I took it for 17? Those requests are going to happen if you allow this in the plan. So those are considerations that you want to have before you make the decision to allow or not these types of withdrawals in the plan. Okay, we're running a little bit short on time, so I'm going to speed through the rest of these here. The Secure Act allowed a new type of in-service withdrawal, which is referred to as a baby distribution. So this allows people to access funds in their retirement plan after the birth or adoption of a child. It is up to $5,000 per birth. And if you have multiples in a birth, then it's per child, right? So if you have twins, you can take up to 10,000, for example. It does require a plan amendment to allow this, and the law allows this distribution to be repaid to the plan. However, the IRS and the Department of Labor have provided no specifics yet on how that would actually work. So this is a very new thing. Not many record keepers, TPAs, or plan sponsors are really ready to allow this just yet, waiting on guidance from the government. Long-term part-time employees is a big thing, big enough where I think we have a webinar that is devoted to this topic. So if you have part-time employees in your plan, I encourage you to hit the webinar link that we're going to provide later on in this slideshow and find the long-term part-time employee webinar, because this is a very important piece in the Secure Act that you want to make sure you are prepared for. I believe either Craig Hoffman or Steve Vest talks about this, and both of them do a great job laying out what this is. So I won't try and recreate the wheel on this item. Required minimum distributions had a change in the Secure Act, and really the change was that instead of your traditional age 70.5 to begin taking distributions from the plan, it is now changed to age 72. So if you became age 72 after 2019, then you now work off of the age 72 date to start your required minimum distributions. Okay, that is the only thing that changed about the RMDs. All of the other rules still apply. 5% owners are required to take them. If you're a non-owner employee and you're still employed, you can defer taking those distributions until you actually terminate employment. Employer contributions, we have all kinds of options for these, right? These contributions in NOVA documents are set up to be discretionary, which give plan sponsors the maximum flexibility in these types of contributions. So if you are looking to change your employer contribution formula, whether it's a match, whether it's a profit sharing, whether it's both, this is the time to be talking with your NOVA account manager about that. New comparability allocations, we do a ton of consulting work on these types of contributions. Use your account managers. They are a resource for these types of discussions, okay? We also have resources that can help you if the 401k plan by itself is not enough. We can talk to you about adding a cash balance plan, or even in some cases talk to you about a 457B top hat plan to go as well. So there are a lot of issues and a lot of opportunity for consulting around employer contributions. If you have questions, if you're looking to plan for the end of the year, get with your NOVA account manager. They'll be happy to help you. All right, plan amendment process. Towards the end of the year, so a lot of these things that we've been talking about today require changes in the plan. And so towards the end of the year, our plan documents team becomes inundated with change requests. So the reason why we have this webinar in August is because we want people to start talking about these types of changes to their plan early, okay? If you have to talk with your plan committees or other people to talk about what you want to do, start that process now so that we can get your amendment done before the end of the year like the law requires. The Secure Act and the CARES Act had deadlines of 12/31 of 2022 to make some changes, but just recently, and too recent for me to update these slides, the IRS came out and extended those deadlines until 2025. So we got some additional time for those types of things. But again, consult with your NOVA account manager for changes that you want to make. We prefer if you have that ball rolling with us by October 1st to ensure that the illustrations can be prepared, that we can do all the amendments, that we can get them all signed by the end of the year. October 1st seems really early, but when you consider that you've got the Thanksgiving holiday and the Christmas holiday plus New Year in there, the actual number of days that people are in the office shrinks considerably after October 1st. So that's why we set that early of a deadline to try and get these changes made. Okay, I'm gonna skip past the investment strategy piece. Okay, so I mentioned before, talking about the additional webinars that Nova offered. This is where you can go to get the long-term part-time employees portion. And with that, I'm going to turn it over to questions. Let's see what we have here. Wow. Okay, we do have a bunch of questions. We are at 2 o'clock, so I'm going to not go through, we're not going to have time to go through and answer these, but we will provide answers in writing, if I'm correct, Yvette, that we can send over to everybody with the wrap up of the session.
Yeah, if your question didn't get answered, just go ahead and email us and we will send a response to you. Alrighty, perfect. All right. Well, just a reminder to fill out the survey at the end of this webinar so that we may track who will be needing a certificate. If you have any questions, please be sure to email us webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you, Jason and Carrie, for your time today. And thanks again, everyone, for joining. We hope you enjoy the rest of your day.
Thank you, everybody. Goodbye.